Hello, everyone, and thank you so much for being here today. I'm Natalia, President of Custom Accounting CPA. I'm really glad you could join me because we've got something important and honestly, pretty exciting to talk about. As you may have heard, new tax legislation was just signed into law by President Trump on July 4th, and it could have a big impact on your tax situation. So today I want to walk you through what this means, how it might affect you or your business, and most importantly, how smart tax planning can help you make the most of these changes. My goal is to help you feel confident and in control when it comes to your taxes, and even leave the session a little excited about the idea of cutting your tax bill down. We will kick things off with a quick intro about Custom Accounting CPA, dive into the brand new 2025 tax legislation and what it means for you, walk through a real life case study, share a special offer that you don't want to miss, and of course, save time for your questions at the end. Our team at Custom Accounting CPA is a team of designated tax strategists who are also licensed CPAs and EAs. We specialize in proactive, forward-thinking tax reduction planning by designing and implementing innovative, customized tax strategies that minimize your taxes and provide a high return on investment by saving tens of thousands of dollars using IRS-approved and court-tested tax strategies. We use our unparalleled knowledge to save successful small business owners, entrepreneurs, doctors, and real estate owners thousands of dollars in taxes every year. We know how to identify special tax credits, uncover hidden deductions, and leverage little-known loopholes to significantly reduce your tax obligations so you pay as less taxes as legally possible, while also reducing your chances of audit. Let's set the stage for what's happening in the tax world right now. The Tax Cuts and Jobs Act of 2017, TCJA, brought sweeping changes to the US tax code, especially for individuals and business owners. But from the start, many of those individual provisions were designed to expire after December 31, 2025. Fast forward to today, with the TCJA set to sunset at the end of this year, a new law, the Big Beautiful Bill, BBB, officially went into effect on July 4, 2025, to extend the 2017 legislation. This new legislation reshapes several areas of the tax code, offering both opportunities and challenges for business owners. Today, we will break down what's changing, what's staying, and most importantly, how you can proactively plan to reduce your tax burden under this new law. This is your chance to get ahead of the curve before these changes take full effect in the coming tax year. First up, the standard deduction. Remember how 2017 Tax Cuts and Jobs Act roughly doubled it? The new Big Beautiful Bill locks that higher amount for good and keeps the annual inflation bump. So for 2025 returns, standard deduction is $15,750 for single filers and $31,500 for married couples, with a small CPI tweak each year thereafter. Millions of folks who used to itemize can keep life simple. No shoebox full of receipts, no Schedule A stress. The most immediate impact of these changes was to cut itemizers from roughly 30% of all filers to just 10%. Most families wound up paying less, although some larger families that benefited more from personal exemptions than standard deductions wound up paying more. Next, personal exemptions. Those went away in 2018, and BBB makes that repeal permanent. Clients sometimes worry they lost something here. So I like to remind that rich standard deductions plus enhanced child tax credit usually more than fills that gap, especially for families with kids. Finally, itemized deductions. Most of the TCJA limits stay in place, but BBB tweaks a big one. State and local taxes, SALT. The cap jumps from 10,000 to 40,000 for 2025, and then indexes upward 1% a year until 2029, before snapping back. That's a huge planning window for anyone in high tax states. Think about prepaid property taxes while the higher cap lasts. Two other brand new twists to keep in mind. Charitable deductions boost. Even non-itemizers now get an above-the-line write-off for cash gifts, up to $1,000 single or $2,000 joint filers. But itemizers must first clear a tiny 0.5% of AGI floor on charitable gifts. So your charitable contribution must be more than 0.5% of your AGI to be able to deduct. And finally, the value of all itemized deductions is capped as if the top rate were 35% instead of 37%. So top bracket clients still deduct, just at a slightly smaller bite. If you cannot clear the new SALT ceiling plus your other expenses, the standard deduction is still your best friend. But if you can, Schedule A might finally be worth revisiting. So, big picture, high standard deduction, no personal exemptions, and selectively friendlier Schedule A. The trick is matching these rules to each client's reality year by year to keep taxable income as low as we legally can. The biggest change back in 2017 was simply cutting tax rates. You can see the chart shows them dropping at every bracket beyond the initial 10%. So, for example, the 15% bracket dropped to 12, 25% bracket dropped to 22, 28 to 24, and so on. The BBB, the Big Beautiful Bill, signed over the July 4th weekend, locks in the Tax Cuts and Job Acts brackets that you see on the screen permanently with no changes. And quick heads up for people aged 65 plus. For the 2025-2028 seasons, you get a sweet extra $6,000 deduction per qualifying taxpayer. Usable whether you take the standard or itemize. It phases out once your AGI tops 75,000, so higher income seniors may only see a partial or even no benefit. Let's talk about one of the most helpful credits for families, the child tax credit. Back in 2018, this credit doubled from $1,000 to $2,000 per child. And here is some good news. Starting in 2025, it's getting a little boost to $2,200 per child. Now, when it comes to who qualifies, the income limits expanded quite a bit in 2018. Single filers saw the threshold go from $75,000 to $200,000. And for married couples filing jointly, it went up to $400,000. Starting in 2025, it gets even better. We will see a 50% phase out for incomes over those limits. So if you are right around that mark, planning ahead could help. Let's also look at the refundable portion. This is the part of the credit that you can get back even if you don't owe taxes. It went up to $1,400 in 2018, and starting in 2025, that climbs to $1,700. That's more money back in your pocket, even if your tax bill is zero. So in short, whether you are already getting the full credit or just becoming eligible, there is opportunity here. And a little planning can go a long way. Starting with 2025 income, servers and other tipped workers can deduct up to $25,000 in cash tips from federal taxable income each year. The break phases out about $150,000 for single or $300,000 for joint filers, and sunsets after 2028. The BBB gives overtime earners a matching perk, a deduction of up to $12,500 for single or $25,000 for merit for overtime pay earned in 2025 through 2028, with the same income phase-outs. And finally, clean energy incentives get trimmed back, unfortunately. Many residential and vehicle credits expire at the end of 2025. Transferability, sell your credit for cash, is mostly repealed after 2027. Big Beautiful Bill raises lifetime federal estate tax exemption to $15 million per individual or $30 million for a married couple starting January 2026. That dramatic jump is expected to drive the drop in taxable estate filings even further, from roughly 4,000 returns in 2017 to about 1,900 under the new rules in 2018. All right, folks, here is the good news for pass-through businesses. The 20% QBI deduction in place permanently. No more 2026 sunset. Even better, Congress lifted the phase-in range, so those W-2 wages limits now kick in at $75,000 for singles and $150,000 for joint filers, instead of $50,000 and $100,000 as it used to be. That means more owners keep the full write-off. And finally, there is a $400 mini deduction, $400. If you have at least $1,000 of active QBI, you will never walk away with less than $400 write-off, even if your number's tiny. Bottom line, the rate stays 20%, but the door just got wider. Now is the great time to fine-tune wages, property, and entity structure so you can capture the full 20% of the deduction. Here is the fast lane version of what Congress just did to depreciation. Full bonus depreciation is back, and this time it's permanent. Anything you buy and place in service on or after January 19, 2025 qualifies for 100% write-off in year one. No more face-down drama and no 2027 cliff to fear. Section 179 got a muscle upgrade. Your immediate expense cap jumps to $2.5 million, with a phase-out now starting at $4 million. Both numbers will climb with inflation, so mid-sized shops can still play. Real-world takeaway: bonus and 179 stack, but watch the order. Claim 179 first, then soak up what's left with the bonus. And remember, most states don't follow Uncle Sam here, so budget for a separate state bill. This is very important to remember. And great news for those businesses who is involved in research and development activities. permanently restore immediate expense for domestic research and development R&D expenses for small businesses with gross receipts of $31 million or less, which means every dollar of US research goes straight to the P&L in year one. No more 5-year drip, and the fix is also permanent. But Congress didn't stop there. There is a catch-up relief. If you already capitalized 2022, 2024 domestic R&D, you can elect a 1 or 2-year flush deduction to sweep the remaining basis. So firms under about $31 million of average receipts may even amend prior year returns and retro expense those same 2022, 2024 costs. But important, location still counts. Foreign R&D stays on the 15-year treadmill. So think twice before offshoring that next project. And here is a tax planning tip for the room. If we front load as much US R&D spending as we can into 2025 and 2026 and go back to amend our 2022-2024 returns to retro expense the costs we were forced to capitalize, we will turbocharge cash flow by yanking a multi-year stream of deductions into the present and turning it into an immediate pile of tax-saving dollars. Starting with tax year beginning after December 31, 2025, C Corporation can deduct its charitable gifts only to the extent total donations exceed 1% of taxable income. That means the first 1% is no longer deductible, unfortunately. Though the familiar 10% ceiling with a 5-year carry forward still applies. So, for example, a company with $1 million of taxable income now gets no write-off on the first $10,000 it gives. Only amounts above that will count toward the deduction. Let me hit 3 more pocketbook changes you will want on your radar. Less 1099 clutter. Great news. Beginning 2026, you only file a 1099 NEC or miscellaneous if you pay $2,000 plus, up from $600 in the past, and payment apps won't send a 1099K unless you clear the old $20,000 or and 200 transaction bar. That's a lot fewer surprise forms for side giggers and vendors. However, very important, state rules may differ. Several states, for example, like Vermont, Massachusetts, already require, and other states already require 1099s at lower amounts. The federal change doesn't override them. Let's talk about SALT, CAP, and PTIT. So these are preserved. The individual SALT deduction, as we mentioned a few minutes ago, jumps to $40,000 and get inflation bump. It begins to phase out at 500,000 AGI, and Congress kept the pass-through anti-tax PTIT workaround fully deductible. So high-tax state owners still get the PTIT write-off plus a high personal SALT shield. So this is a great topic for tax planning as well. And here is a quick planning levers to keep more cash in your pocket this year. Keep your joint AGI below $500,000 so you can claim the full new $40,000 SALT deduction on top of your PTIT credit. Simple levers like deferring a year-end bonus or maxing out retirement contributions can get you there. and lock in your 2025 petite election and estimated payments early. Think March 15 in New York to guarantee that 100% entity level deduction flows straight through to your personal return. Now let's talk about qualified small business tax sale. Starting with C Corp stock issued on or after July 4th, investors can pull cash out in just 3 years and exclude half the gain, jump to 75% after 4 years, and still hit the full 100% after 5. The per investor cap climbs to $15 million, and companies can keep raising until the assets touch $75 million without blowing qualified small business tax status. Planning twist. If you are about to issue equity, consider it doing now, as new clock and bigger caps apply starting July 4. However, as a reminder for founders, pre-July 2025 QSBS, qualified small business stock, keeps the old 10 million cap and straight 5-year rule. So track your share lots separately to maximize your benefits. As we concluded this webinar about changes in BBB tax law, I would like to emphasize that proactive tax planning is more crucial than ever to ensure proper response, but yet often overlooked aspect of running a successful business. While traditional CPA services focus on compliance, making sure your taxes filed correctly and on time, tax planning involves a proactive approach to minimize your tax burden throughout the year in response to internal and external changes. And that's where custom accounting CPA comes in. We hold elite and unique certified tax coach and certified tax planner designations that very limited number of tax professionals have the privilege in obtaining in the entire United States of America. In the last 3 years only, we helped to reduce our clients' taxes by over $4 million through leveraging tax code and implementing basic and advanced tax strategies. I would love to share a case study with you that clearly shows just how powerful proactive tax planning can be. This slide visually illustrates the financial impact of proactive tax planning. If you look at taxes paid bars, business B, that has a yellow bar, pays significantly less in taxes, only $120,000 compared to business A's $420,000. This tax savings of $299,000 directly impacts their bottom line, allowing more cash flow for investment, expansion, or even increased personal savings for the business owner. Here is a closer look at the financial impact of these two approaches. Business A on the left, which only uses traditional compliance services, has a net income before taxes of $1 million. Without any proactive planning, they pay $420,000 in taxes, assuming a tax rate of 42% for both federal and state. This leaves them with a lower net income after taxes. Now let's compare this to business B on the right, which engages in proactive tax planning. They also have a net income before taxes of $1 million, but they implement several strategies, such as maximizing retirement plan contributions through cash balance plan, implementing leveraged charitable trust strategy, which, by the way, requires no out-of-pocket charity contribution, and oil and gas investment with $100,000 being invested that helps to reduce taxable income by $85,000. In addition to tax reduction, this strategy also investment strategy with a healthy ongoing ROI. These strategies reduce their taxable income to $326,000, resulting in only $120,000 in taxes paid, a saving of $299,000 compared to business A. At this point, we can open the floor for any questions, so just type them in a chat. And if you don't have any questions, feel free to reach out by email or phone after the webinar with any question that might come up later on. We look forward to helping you achieve your financial goals, and bye for now.